This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
It is Thursday, January the 26th, 2017. I'm Gord Long. As is normally the case, I have a lot of charts for us to go through, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I will be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates global risk. Therefore, the slides this morning will focus on our other three report areas of the monthly report, the macro, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on investment strategies for Trumponomics. In this regard, I'd like to cover the following subjects shown here. The Trump election ignited movements in the financial markets of historic proportions. Markets shot up in the case of the U.S. equity markets as it approached and then exceeded Dow 20,000, and down in the case of the bond market as the U.S. 10-year Treasury topped 2.6%. Sentiment and euphoria towards the expectations for the pro-business Trump policy initiatives have seen something which few newer investors, I'm sure, have witnessed before. The three market elixirs of 1. Tax cuts, 2. Fiscal stimulus, and 3. Regulatory relief proved to be the magic potion which resonated with investors globally. The problem is that the policies are long on intent, but short on specifics. When it comes to financial markets, the devil is always in the details. This has left an unprecedented degree of economic policy uncertainty as the Trump administration assumes office. The uncertainty is global in size. The Trump administration has laid out a very aggressive 100-day plan called Contract with America, which only time will tell if it is possible to achieve. Expectations are high that it will be, and therefore what is also high is the risk of disappointment. If you look at the period after the election of a new president, you see that expectations and promises start to modify. The seasonal chart by Dimitri Speck, the founder of SeasonX and head analyst of 90-Tage Trader, shows the typical price pattern of the Dow Jones Industrial Average in the course of a year averaged over the past 117 years. What we see is, first, as the vertical scale indicates, the Dow Jones Industrial Average rises by nearly 5% on average. When dividends are added, this compares to the risk-free yield on 10-year U.S. Treasury notes, typically. Particularly strong gains tend to be posted in the final 2 weeks of December. What has now been labeled as the Santa Claus rally sees price rallies most of the time. Third, between early May and late October, the average gain has been zero, though. This confirms the so-called Halloween effect, according to which the summer months typically generate no returns for stock market investors. Next, we are looking at the typical seasonal pattern in the Dow Jones Industrial Average in post-election years, such as the year 2017. If elections can affect stock prices as strongly as has happened in the wake of Donald Trump's victory, they may have a noteworthy effect on the subsequent years as well. The next chart is constructed in the same manner as the previous one, but instead of every year, only every fourth year, namely every post-election year, is included in the calculation of the seasonal average. What we see here is, first, volatility tends to be greater than in all years combined. 2, prices tend to decline until late February, then rally and decline again in the fall. Third, overall, the average post-election year has been slightly weaker than the average year since 1900. And fourth, most importantly, the intermittent corrections tend to be much fiercer than usual. This includes a typical decline from January until the end of February, as well as quite strong downturn in the fall. Next, we look at post-election years that have entailed a change in government. This is to say, a change from a Democratic to a Republican president, or vice versa. That is actually the case that most closely resembles the current one. Such changeovers have happened 11 times since the year 1900. Similar to the previous chart, we once again show the average pattern of the Dow Jones Industrial Average in post-election years, but this time only the years in which the new president hailed from a different party than his predecessor are taken into account. What we see here is, first, the average pattern that forms in the post-election years which involve a change in the government party is quite distinctive and differs noticeably from what usually happens. 2, no net gains are achieved between January and late October. 3, only the final 2 months of the year tend to generate a positive return for stocks. 4, generally volatility increases even further. And 5, particularly noteworthy, is the pronounced decline that tends to occur early in the year into the end of February. On average, a loss of 5% has been recorded. While 5% doesn't sound like much superficially, keep in mind that this is a long-term average. It is normally important for the president to use political capital wisely. This could be the reason, not least because 9 of the last 12 presidents saw their popularity near peak and leak within months of the inauguration, making it progressively more difficult to get things done. Reasons for this may include teething problems encountered by the new administrations or investors making a more realistic assessment of what the new administration will actually reasonably be able to achieve. Typical post-election years that involve a change in the governing party therefore suggest that there will be high volatility this year, including quite a bit of weakness in the end of February, with the market remaining difficult until the end of October. Keep in mind that the seasonal chart is an average of past market performances. Hence, there will be occasions when the market will end up acting differently. The purpose of seasonal charts is to help narrow down probabilities and therefore help improve investment results over the long term. Simply said, after the election party, a hangover usually looms. We may possibly have a classic case of buy on the expectations and sell on the post-inauguration realities. The current narrative around the Trump election is still focused on fiscal stimulus, tax, and regulatory cuts. I think it is critically important to make a distinction between the House and the Senate. Paul Ryan will have an easier pathway towards passing legislation through the House than Mitch McConnell will in the Senate. Ryan can easily move Obamacare repeal and replace and his tax blueprint, while McConnell won't have nearly as much flexibility in the Senate. It remains the case that investors aren't paying enough attention to the logistical, ideological, and fiscal constraints facing Trump, Ryan, and McConnell as they look to move the agenda through Congress, and there still doesn't seem to be enough appreciation for how enormously contentious and complicated health care repeal and replace will wind up being. There is a strong possibility that we can expect, 5 stages to occur as part of this unfolding Trump trade. 1, a promise stage. 2, the deal-making stage. 3, the enactment stage. 4, an impact stage. And 5, the payback stage. So what does this mean for the 5 stages of the Trump trade? First, the promise stage is done. It has been powerful precisely because it involved a possible paradigm shift in cyclical stimulus and because the expected U.S. policy mix is seen as so differentiated from the rest of the world. Secondly, the deal-making phase will take shape over the next 100 days. Here we will start to get a better feel for the scale of fiscal stimulus and therefore the spillover onto monetary policy. The complexity of far-reaching changes could stretch this phase, making for more frustrating trade conditions, especially since the Fed is not under too much pressure to front-load their actions without more clarity on fiscal policy. Third, for the enactment phase, where deals are signed off on in second half of 2017, the market will be particularly responsive to issues that relate to timing of impact, multiplier effects, the breakdown, not least as it relates to far-reaching corporate tax reforms that will impact trade patterns, FDI, equity and bond flows, and protectionist elements where retaliation is a real threat. Not to be forgotten in this phase is the overlap with changes in key Fed personnel, including the Fed chair appointment. The talk of a more rules-based Fed, or at least having the Fed chair explain departures in policy from a rules-based system, is apt to be seen as hawkish, especially given how accommodating policy is now. Fed funds is tracking 100 to 125 basis points below the Taylor rule signal. Fourth, the economic impact phase. The growth impulse will likely be in 2018, with questions on how much the upturn is accelerated and elongated into, say, 2019. The inflation impulse could have even longer lag unless there is a border adjustment tax that hits import prices quickly. This will be a phase where we better understand how much the Fed will tighten in this cycle and whether the peak in the US dollar is in 2018 or even beyond. If there's a genuine acceleration in growth, the market could make sizable adjustments in Fed expectations, and this may well prove another important period for trending markets. And fifth, the payback phase. Fiscal stimulus often brings growth forward, usually with a payback in the form of slower growth as the stimulus wears thin. Similarly, there is a reversal in financial prices. Think of this as the equivalent of what we saw for the United States dollar in the 1982-1984 period, where the rally gave way to the payback of a much weaker U.S. dollar in 85 and 87. In current circumstances, payback is more relevant for 2019 and beyond. Events conspire to derail our perceptions of presidents. When we look at their platforms, we think we know where things are headed. But in modern times, the only two presidents that I can think of who really got their ideas and platforms enacted wholesale were FDR and Ronald Reagan. Everybody else has gotten compromised or has had events overwhelm them. Washington's a tough place. Presently, exuberance couldn't be much higher. The aggregate risk appetite indicator and 3-month momentum change clearly shows this. We are at highs not seen since the pre-dot-com financial crisis peaks. I believe, based not only on my macro analysis, but also my study of cycles like the Kondratiev cycle, that the debt supercycle is in the process of ending. This chart of recent highs in the University of Michigan Consumer Sentiment Index suggests to me a classic head and shoulders topping pattern is now forming and completing. This becomes more than a conjecture when we see the steady decay in GDP on the bottom of this chart. How does this support such high levels of sentiment other than by a cheap credit and a recessionary period long overdue by any historical measure? Let's look at the intermediate term, or what I believe is about risk. Options professionals now appear to be extremely worried about the potential for a huge downside tail risk event. They are now pricing in the third highest chance of a black swan crash in history. And with the skew at over 146, markets have only been more fearful of a collapse twice in its 27-year history. And as for those who are not familiar, the definition of skew is that it is calculated from the prices of the S&P 500 out of the money options. Skew typically ranges from 100 to 150. A skew value of 100 means that the perceived distribution of the S&P 500 log returns is normal, and the probability of outlier returns is therefore negligible. As skew rises above 100, the left tail of the S&P 500 distribution acquires more weight, and the probabilities of outliers returns become more significant. One can estimate these probabilities from the value of skew. Since an increase in perceived tail risk increases the relative demand for low strike prices, increase in skew also correspond to an overall steepening of the curve of implied volatilities, familiar to option traders as the skew. The bond market is showing similar worries, as the U.S. Treasury total return drawdowns indicates we have experienced increased worries preceded by only major crisis events. I believe what they see is, one, everyone that can get on board is on board. Unfortunately, everyone on the same side of the trade, and that, as the contrarians know, typically never works out quite as expected. Who is left to continue the buying required to push asset values higher? Secondly, a potential policy shock from the new Trump administration, i.e. an ISIS plan, protectionist relationships, and the list, frankly, from Trump goes on quite extensively. We have an unprecedented degree of U.S. Treasury bond shorting, which makes it ripe for a short squeeze of historic proportions here. Also, we have no one shorting the equity markets, on the other hand, as the short interest is plummeting. And then we have everyone piling into the U.S. dollar and going long the U.S. dollar. These are extremes, and everybody, as I said, on the same side of the boat. This is not going to end well, as a lot of people are going to be proven wrong one way or the other. In the bond market, we have sell-side speculators short bonds, while the buy-side investors, I think they're the smart ones typically, are buying duration. Who is wrong? Time will only tell, but there's a correlation pattern in these charts, actually, if you look at them carefully. In the long term, it's about fundamentals. One of the ways to rationalize much of the above is to look at the fundamentals, which Warren Buffett says in the long term the market will eventually reflect via regression to the mean and become more in line with historical measurement values. If we look at the history of the velocity of money as defined by M2 versus the U.S. Treasury yield, seen here, we see a very strong correlation. Recent coverage of Lacey Hunt by Bloomberg, and they called it the man who called the last bond market 40 years ago says buy bonds, was something that we paid particular attention to. Our analysis suggests Lacey Hunt, and I've interviewed him a number of times, and he's a brilliant man, is right in the short term, that is first half of 2017 and initial, which is shown here in the initial black circle, and longer term, that is 2018, second half and on, but may possibly be exposed in the intermediate term, that is the second half of 2017, first half of 2018, shown in the initial rising black line circle and the red arrow. We believe, though, we have a much higher inflation rate in the U.S. than is reflected in the CPI, and it is not showing in the U.S. M2 velocity because of falling real disposable incomes, that is, falling standards of living. Real U.S. consumption is flat to falling, and as a consequence, money velocity continues to weaken. Additional global price deflation is being imported due to a strong U.S. dollar and lost global pricing power, that is, oversupply and excess capacity. Adding to the above is the fact that a positive U.S. real bond yield with a strong dollar makes them attractive in a global negative inflation rate policy environment. The headwinds that the new Trump administration faces are daunting, to say the least. The list is actually too long to cover here, but let me give you just some highlights that his policies must rapidly overcome, if at all. One is cycles. As we've outlined in previous work, all cycles we study are reflecting a period where they are heading down for various reasons into early 2020. This coincidentally overlaps with Trump's first term, or ominously, possibly his only term as president. The extensive work by Peter Turchin, which we've also discussed, is quite clear that we are entering a secular cycle downturn associated with a rejection of the status quo, anti-establishment, and anti-globalization. Second, shifting demographics. We presently have 75 million baby boomers about to retire. They are retiring at a rate of 10,000 per day. This is a period in their life where they reduce their spending consumption, start withdrawing their savings, and draw down their investments in their IRAs. It is estimated, for example, that $350 billion per year will soon start leaving the financial markets based on just simply forced IRA withdrawals that they're required to make at the age of 70. Additionally, the average age is getting older and entering a period of reduced consumption. What few fully appreciate also is that the growth rate of the U.S. population, even with immigration, is at a rate last seen during the early years of the beginnings of the Great Depression. Thirdly, we have slowing China and global trade. Global trade is slowing dramatically, and we've talked about this numerous times in the last year and a half. And as a consequence, China is slowing dramatically. On top of this, massive debt spending since the 2008 financial crisis in China to employ some of their 1.4 billion population seeking work, which turned out to be to build ghost cities and malls, appears to have run its course. As outlined in this year's thesis, The Illusion of Growth, global GDP growth is exactly that, an illusion. Our research work suggests real economic growth, if reported properly, is actually contracting. Fourth, looming and an overdue U.S. recession. I don't know when people started believing that recessions are a thing of the past, but they haven't been made extinct by central banks' easy money policy as far as I'm aware. Recessions in the first year of a U.S. presidency are not at all uncommon, especially following a two-term presidency. Cheap money can only defer the natural cycle so far. By any measure, we are now within the window. It may not occur in 2017, but by 2018 it will have become a historical anomaly if it hasn't occurred. Fifth, the U.S. dollar shortage globally. If the new fiscally conservative Congress and Trump's trade policies get enacted, there is a strong likelihood that the U.S. current account deficit will be reduced. What is important here is that this squeezes the rest of the world who have come to survive based on this flow of debt into their countries as part of the Triffin paradox, which I've also discussed previously. Sixth, the tectonic forces at play. The debt supercycle, as I've discussed many times, is likely coming to an end. And the powers to be will do everything in their power to stop it from occurring, which I've also discussed, and I've written just recently on my beliefs that their Federal Reserve and up to 12 other central banks are now buying the stock market. The gap between expectations, enthusiasm, and reality is large and seems to be growing by the day. But there is also a strong chance that, 1, the markets may not care until the end of the summer, i.e., investors may give the new White House the benefit of the doubt until August or September. And 2, the tape may not really need material action from Washington. The nominal growth improvement predated November 8th by several months. And if the present economic earnings trend can persist, the S&P could be able to do 127 to 130 in earnings in 2017 and 135 to 137 in 2018 without any of the Trump-Ryan Big Three programs. We need to break here to respect your time, but in the next Under the Lens, we'll continue this. Then I want to address specifically 3 things: where we see the Trumponomic investment winners and losers to be, 2, why Trumponomics may potentially fail, and 3, what the post-Trump inauguration first half roadmap by then is shaping up to look like. But remember, no matter what, we can expect the government to print the money to solve any and all perceived problems. It is the only answer politicians will ever agree on. Invest accordingly. As a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a very knowledgeable and qualified and well-informed financial advisor. So until we talk again, may 2017 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.